Hello and good afternoon. In this video we will try and visualize how does it work when we try to value a business or a stock based on a multiple called enterprise value compared to EBIT. And I'll share an illustration how you can remember how it makes sense and why it makes sense for me and for many investors to use that metric instead of price earnings. So let's begin with an illustration that you are on an island, and there's a few pirates over there that you go and ask if they have something for sale. And yes, they have this little they have a little stand there, a little small business. It's a table and it's some goods for sale there and so on. There's also a big treasure chest that has a lot of gold in it. And and then he says that you can buy everything from us. We don't want to have this anymore. And this chest with the gold, it's locked onto the 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 building and the stand here, so we won't take it with us. You have to buy everything and also the chest and the gold inside. Okay, so how much gold is there in the chest? And I am interested in buying your little beach business here with the coconuts and the bananas and this golden chest. So okay, then, but I need to know how much gold is in the chest because that's important. Okay, so the pirates, they say yes, this chest here is it's if you open it, you will see that there's 10,000 gold pieces here in that chest, and we would like to also, for the rest of the stand, we would like to have say 30,000 gold pieces because it earns a lot of money. They sell a lot of coconuts and bananas, so you will probably make the money back in 2-3 years. So we want 30,000 gold pieces for the business, but it has 10,000 gold pieces inside the chest. So would you like to buy it? Okay, so that was an interesting appeal there. So we see here we have this little stand that sells bananas and coconuts and has this treasure chest, and then if we buy the whole thing, we also get kind of this pile of gold also. So yes, then that's actually brings us to the enterprise value here. So what is kind of the price of the business and what do we get included? The gold pieces. So let's see what Gemini says here. I am on a stranded island, and the pirates on it, they offer to sell their coconut and banana stand. Okay, let's see here. The stand has an installed and fixed treasure chest, and it contains 10,000 gold. Okay, and the pirates want 30,000 gold for the total price. So if I give them 30,000 gold, then I get the whole the banana and coconut stand, and also included the chest with 10,000 gold. I hope they are not lying, and there is indeed gold in the chest. And we ask the pirates, does this stand owe any bananas, or if they owe any gold to the sellers of the fruits, etc. And the pirates say no. Okay, please use this meta story to explain how it works with EV to EBIT when acquiring the whole business. Okay. So then let's see. And so we have this. We pay 30,000 gold, and we get it included. And how does that correspond to buying a business on the stock market, and then having some kind of cash included? Okay. So here you can read. It's a perfect analogy for understanding professional value businesses. When we buy the whole thing or buy many banana stands, and maybe they have different amounts of gold in the chests, and we try to buy all of them, and then how much does it cost us really? So the equity value, market cap, this is the sticker price that the pirates are asking for. You hand over 30,000 gold pieces and walk away with the keys. Equity value, 30,000 gold. How much is the enterprise value? The enterprise value is the actual cost of the business operations. So it's like a theoretical takeover price. So we use the logic. The enterprise value is the equity value plus the debt, but they didn't own any gold to the vendors, and minus cash. So that's the gold in the box. In the scenario, the debt is 0 because the pirates don't owe anything, and we take over the business and we don't have any debt. So we just start with a blank sheet, but we have a chest with 10,000 gold in it. So enterprise value is then the formula above, 30,000 for the price. That's actual what we have to pay. But we can subtract 10,000 gold because we have it included in the whole package. So the total enterprise value is 20,000 gold. So the takeaway, even though you paid 30,000 gold pieces, the business is the bananas and coconut business is only costing 20,000 because you immediately recover 10,000 gold inside the chest. So that's how it works, okay? And we can see this in the stock terminals, and then you see market cap, and you see enterprise value, and then you see how it works. And that is important because imagine if you took over this banana stand and you buy the whole thing. And by the way, it's the same thing if you buy just 1% of the business. Because if the pirates were owing 100,000 gold to the settlers on the island, then it would take a long time for us we would have to sell a lot of bananas and coconuts to cover the debt before we can take out the dividend, right? So that's very important, and that should reflect what price we are actually effectively paying here, or how much the business really costs. Okay, and here, enter the EBIT, the fruit profit. So why do we care about the 20,000 gold as enterprise value? Yeah, because we want to know if the stand is a good deal compared to how much it earns. So let's say the stand makes 2,000 gold per year after paying for the fruit and the monkey labor, or monkey business. Then before you pay any taxes to the island king, then your EBIT is as such. Yeah. The multiple, so this is kind of how much is the business price compared to the profits before taxes and so on. So to see if the pirates are ripping you off, let's see what is the multiple. It's 10x because we effectively paid 20,000 for the business. We paid 30,000 gold, but it included 10,000 gold, so we paid 20,000 to take over the whole business. And every year we have a profit from the coconuts and fruits of 2,000. So if the earnings are flat, and yeah, then it means it will take 10 years of the operating profits to pay back the actual cost of the business. But of course, this is before the interest and the taxes. So it might take a longer time with no growth. Some businesses, they grow and grow the EBIT. So that's also important. So why do we use the EV or enterprise value instead of the sticker price? Okay, so if you only use the 30,000 gold to calculate your return, the math would be like this: 15x, not 10x. But that's misleading. It makes the business look more expensive than it actually is. By using enterprise value, you are looking at the naked value of the business assets without being distracted how much cash is sitting in the bank or how much debt is owed. And this, all the businesses usually have either a lot of debt or a lot of cash, actually. And that is part of the value when you think that you want to buy the whole business. This is important, and it's also important for you who buy just shares in the business, because per share, this is as important as for the whole business. Okay, so that's the summary. And the bottom line: if the pirates were lying and the chest was empty, then the enterprise value would jump to 30,000, making the deal much worse. Always check the chest before you sign the scroll. And here you see that the distinction between the price and the value of the business is, that's how we see it, what we actually pay for the business. The net cost to acquire the whole business is the enterprise value. Okay, so that's the. I hope that analogy was useful, made it a bit more clear. It's always fun to try and buy these, say, nets. For example, when you buy a box of gold, and you can buy the whole box for much lower than the content. Maybe it has lots of shares and securities inside the box, and some gold, and some bananas that are basically free because you pay a lot less, but only if you manage to open the box, or if the managers want to open it up and give it to the shareholders. So I said that in the end of the video, let's have a look at how does Joel Greenblatt explain it, the usefulness of using EV and EBIT, and also the return on and also the return on fixed assets and net working capital, the magic formula. And here, always before I read the book, I typically used the price earnings ratio always. But this businesses are different; they are financed differently. But if you have the mindset of just buying the whole business and you can finance it however you want, then it's the EBIT that is kind of the simple way to compare how much the businesses are earning. Because taxes and interest, that can vary a lot depending on the situation of the business. But the EBIT, or the operating profit, that's the easier way to compare businesses with. So Joel Greenblatt, he architected the magic formula. He designed a systematic, no emotions allowed way to find wonderful companies at bargain prices. I recommend reading this little book that beats the market. He's a really great writer, and I recommend also to see his lectures on YouTube. from the early 2000s, I think, and I wish I had seen those and attended those classes before, or at all, yeah. But read his books. I also recommend the yellow book, You Can Be a Stock Market Genius. Okay, so he ignores traditional metrics like P ratio, instead look at these factors. The bargain factor, okay. Here you see how much you can earn from the price. So he looks at EBIT at enterprise value. That's the opposite, just inverted, what we just looked at. Because then you see, here as the example, you earn 2,000 gold, but you can see at different companies here that it's comparing, it's like the earnings yield in a way, that you see how much you're earning in EBIT, and then you see what does the whole business cost, which is the enterprise value. So you want the goal to find companies with high earnings yield, compared high EBIT compared to enterprise value. That's a very clean metric, and it compares bananas and coconuts with the different financing. So even if they have a lot of debt or low debt, it looks through that complexity. So the wonderful business. We want to have a cheap business and also a wonderful business that has a high return on capital. And this is a bit of bonus for you here now, and it's early in the channel, so but this is going to be relevant in the future videos, by the way. So you measure how good is the business, because you want to have something that you can build new stands, and you can have the same profit of 2,000, and you want this business to have a high EBIT and a quite low capital that needs to build a stand. Okay, so you want, when you buy the business and you build new stands yourself, you want to have as much earnings as possible on the cost of maintaining and having the business. And a business is usually built up with the fixed assets. That's the wooden stand, and it's the treasure chest, and it is the shelves, and the sign where you have your offers. And it's also the net working capital, that is the gold that you have inside the chest, because you probably need to have some change and some money laying in the business. And also, by the way, the bananas and the coconuts is also part of the value in this equation, the working capital. Yes, so then net working capital, yeah. In your island stand, this is the gold. You need to keep it tied up, as I said, plus the accounts receivable. If a local tribe owes you for coconuts they already ate, maybe you gave them coconuts first, and then you expect them to deliver gold in a week. You need to buy a week's worth of bananas in advance, so it takes some capital to stock the inventory. And a great business doesn't need much gold tied up to make a profit. Just having as little gold to have the asset and the business working as little as possible. And then the same goes for the fixed assets, which is the wooden stand, as I said, and machines for the coconuts and the banana storage crates and so on. So companies can make 10,000 gold using only a small wooden stand. That's it's a much better business than one that needs massive expensive factory to the same 10,000 gold profit. Of course, because if we have one nice coconut stand on the island, we can then copy the concept and franchise and build another one at the same price without... we can build it ourselves. It's a good business, and we just want to build it as cheaply as possible, of course, and have the same profit. Okay, so together we want to have rank the earnings yield. What is the cheapest business? And then rank by the most efficient businesses, return on capital. And we combine the ranks. So that gives a magic score. And that's a method I can show you that you can find in a tool that I make for you if you want to compare all your good businesses, maybe even how good they are, and compare it with the current stock market price to get the earnings yield and the cheapest businesses, and combine good and cheap, and then use that as a basis if you want to act and buy or sell and try to get most amount of value, best quality at the lowest price. And that's how it works. Yes, so the details are here if you want to see calculations of that, but I hope that was a nice idea. How does this enterprise value work in comparing to price earnings ratio? And I like that, and again, if price earnings ratio works also, but if you have, for example, a lot of debt and you have a lot of interest, maybe you pay, you have a profit of 10,000 gold, but you pay 3 or 4,000 gold interest per year. That reduces the profit a lot, and that makes it a bit not so easy to compare if a price earnings ratio is useful or not, because the real profits of the business is then it's affected with a lot of debt and interest. So it's much cleaner to see if it makes sense using this metric. And that's I hope that was a good analogy, and if you enjoyed that kind of explanation and are interested in watching the next video, I appreciate it. Give a like if you do so, and hope to see you in the next video.